You know, Warren Buffett famously bought his first stock when he was just 11 years old, and he actually still jokes that he regrets starting so late. Well, welcome to today's Explainer. I am absolutely thrilled to have you here because we're going to unpack something truly fascinating today. We're looking at the mechanics of wealth, but honestly, not in the way you usually hear about it. Forget about needing some massive inheritance, or hitting the lottery, or finding the next big crypto coin. Today, we're focusing on understanding the true, sheer power of small, consistent investments made over a long period of time. It seems almost too simple, doesn't it? Just asking the question, what actually happens if you invest just $100 every single month? I mean, it's a really small amount. It's maybe the cost of a few coffees or a couple of streaming subscriptions. But when you apply that modest amount to the right financial engine, the results are honestly staggering. Okay, let's dive into this. To give our numbers an anchor, we'll use the historical benchmark of the S&P 500. Now, we all know the drill here: broad market index funds or ETFs. We really don't need to get bogged down in the basic mechanics of how an index actually operates, because what really matters for our journey today is simply the historical engine of the broader US market and what it can do when you feed it a little bit of steady capital. So let's go ahead and establish our baseline. If you commit to investing $100 every month, how much is actually coming out of your pocket in a given year? It's just $1,200. That is your total annual contribution. To put that into perspective, that is way less than what the average person spends on takeout in a single year. It's totally manageable, it's consistent. But how exactly does that tiny seed grow? Let's fast forward a bit. For these upcoming milestones, we're going to assume an illustrative 8% average annual return. At the 5-year mark, you've contributed a total of $6,000 of your own money. So that's the $1,200 a year times 5. Your hypothetical portfolio at that 8% return would be sitting at approximately $7,350. It's pretty modest, right? I mean, you've made some money, sure, but it's not exactly life-changing yet. And honestly, this is the exact spot where a lot of people tend to lose patience. But you have to wait for the math to do its heavy lifting. Right now, you're basically just building kinetic energy. By year 10, something pretty fascinating starts to happen. You've now contributed $12,000 straight from your own pocket, but your hypothetical portfolio has grown to around $18,300. Just think about that gap for a second. That is roughly $6,300 that came purely from growth, not from your hard-earned cash. This right here is the very beginning of the snowball effect. The momentum is just starting to build. Let's jump to the 20-year milestone. This is essentially your massive tipping point. Your total contribution over 2 decades is $24,000. But your portfolio? It could potentially be sitting at around $59,000. Do you see what just happened there? The potential growth portion of your portfolio is now significantly larger than the actual cash you contributed. Your money is literally working harder than you are. This is the exact point where long-term investing becomes incredibly exciting. 30 years in, and all that patience is really paying off. You've methodically put away $36,000, but that hypothetical portfolio value has completely skyrocketed to approximately $149,000. And this brilliantly illustrates the magic of what's happening behind the scenes. The gap between what you've put in and what you actually have is getting wider and wider at an accelerating pace. Now we're going to look at the grand finale, a full 40-year investing lifetime. Let's do the basic math on your actual contributions first. $100 a month for 40 years. That means over 4 entire decades, the total amount of money that actually left your bank account is just $48,000. But that $48,000 doesn't just sit there gathering dust. Thanks to that assumed 8% hypothetical annual return, your portfolio value completely explodes to approximately $311,000. No way, right? Your portfolio value is now many, many times larger than your total out-of-pocket contributions. You've turned a mere $48,000 into well over $250,000. Seeing those numbers is completely awe-inspiring. But as an explainer, we can't just look at the shiny end result. We really have to understand the underlying mechanics. So what actually made the difference here? How on earth does $48,000 naturally turn into $311,000 without you doing any extra physical work? The answer is the incredible, undeniable power of compounding. We all know the basic idea of investing some principal for a return, but the real magic kicks in when your money essentially starts acting as an employee. You send your dollars out to work and they earn a return. But then those returns go out and hire more employees. Your money is working for you, and then the money your money made starts working for you too, creating this massive, self-replicating cycle of wealth. And this brings us to a really fundamental truth of personal finance. Time, when it is combined with compound growth, is your ultimate advantage. There's a very good reason Albert Einstein is often, albeit apocryphally, credited with calling compound interest the 8th wonder of the world. He supposedly noted that he who understands it earns it, and he who doesn't pays it. The biggest takeaway here isn't that you need to invest some massive, intimidating amount of money up front to be successful. The real secret is just giving your money a long, long time to compound. Starting early and being consistent absolutely beats waiting around trying to invest a giant lump sum later on. But to make sure we stay perfectly grounded here, we do have to look closely at our baseline assumption, that illustrative 8% annual return. We really need to talk about what that actually means in the real world. So the crucial point is understanding that this is an educational tool, not a crystal ball. Because the stark reality is 8% is not some guaranteed market return. It's purely a hypothetical assumption used for the sake of this mathematical illustration. Out there in the actual stock market, you're going to have years that are absolutely fantastic, but you are for sure going to have years where the market crashes and your investments lose value. It's absolutely vital to remember that past performance is never a guarantee of future results. Furthermore, real-world factors, things like fund management fees and capital gains taxes, will naturally eat into your actual outcomes over time. So that $311,000 is not a rigid promise. Rather, it's a demonstration of pure mathematical potential. But even when you factor in all those real-world variables, the underlying math of compounding remains one of the single most powerful forces in wealth creation. It all relies on consistency and, most importantly, time. So as we wrap up, I really want to leave you with a question to reflect on regarding your own financial habits. Are you giving your money enough time to compound? Take a moment and really think about it.